Welcome back, investors. Thanks for joining in. Today we'll be looking at British American Tobacco, a stock that has been underperforming the market for some time now. This favorite amongst income investors has been in a downtrend since its peak in 2017. Today the stock is trading 70% from its all-time high and yielding close to 10%, making it an attractive investment for dividend investors. The overall tobacco sector has met a downturn, seeing as these companies are looking for alternatives that could drive future growth. BTI is no different in this. They have made significant investments in companies like Vuse, who provides vapes, and Velo, that is a growing player in the oral tobacco industry. When looking at their 2023 half-year report, we can see that currently these alternative options to cigarettes are making up only around 15% of their revenue, which in defense to BTI is a fast-growing area of their business. To get a broader view of the financial performance, we'll be hopping over to QuantView, our stock insight tool. Here we can see that the revenues have been in a steady uptrend over the years. It's good to mention right now that BTI reports in British pounds, but that these numbers that will be shown here are in US dollars. We see massive spikes in EBITDA, net income, and earnings per share in 2017, when BTI acquired Reynolds American, a large player in the tobacco industry, at a 26% premium to its share price. This caused the long-term debt to almost triple, while the cash pile remained quite small. Debt to EBITDA has risen over the years as well because of this, making them go above the 3 times, which is higher than we like to see in our analysis. We'll get back to that later in this video though. Because of the sell-off since 2017, the multiples have come down a lot. The PE ratio has gone from around 20 to under 10 in these years, and the price to sales is 4 times lower than it was at its peak. Now that we have a general idea of how BTI has been performing, let's zoom into some of the metrics to see if BTI fits our preferences when valuing a stock. But before that, if you'd like to get access to the stock insight tool and the valuation models that we'll be using in this video, you can head over to our Patreon that will be linked in the description. Thank you in advance. We'll be performing our valuation in 3 steps. First is the margin of safety. In this segment, we'll be assessing BTI's key metrics and ratios to determine if we should be more or less cautious when determining our fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on various different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine this final valuation of the company, we'll be using our margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 30% that can never go below 0%. The margin of safety will be based on a bunch of different metrics, and to see how much we should add or deduct from a margin of safety, we use a scale. We're using 4 colors in our scale. Bright red mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction. And we're using 3 colors. Bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at will be focused on growth. Here we'll be looking at the earnings per share growth and the free cash flow per share growth. Here we can see that the earnings per share growth has been in an uptrend. It has gone from $3.36 a share in 2018 to $4.92 a share in 2023. This is an average growth rate of 9.26%, making it miss out just by a little bit on the 5% margin of safety reduction that it would have gotten if it was 10%. So no change in our margin of safety on this metric. The free cash flow per share growth is a little bit different though. If we look from 2018, which we use as the beginning of our benchmark pretty much, it has gone from $5.22 to $5.62, which is a growth, but it's only 2.1% if we look at the growth in average between these years, which makes it just fall in the orange part of a scale, meaning no change in the margin of safety on this metric. Next we have the financial health metrics, and here we'll be looking at the debt to EBITDA and the Altman Z-score. The debt to EBITDA is calculated by taking the debt of the company, subtracting the cash from it, and dividing it by the EBITDA. Out of this we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for British American Tobacco, as we saw already earlier, it is very high. It would take 3.5 years of EBITDA to pay off all of their debt, which falls above the 300% that we talked about earlier. So it adds 5% to our margin of safety on this metric. And next we have the Altman Z-score. And the Altman Z-score is used to predict the likelihood of a company going bankrupt. A score below 1.8, it means that the company is pretty likely to go bankrupt. And if it's above 3, it means that their financials are very much in check and there's no worries to be had there. An Altman Z-score is calculated by using a bunch of metrics like working capital, total assets, total liabilities, and sales to total assets. As we can see, the Altman Z-score for BTI is not that good. It's only 1.3 and it falls below the 1.8 that we would like to see as a bare minimum in our scoring. And this adds another 5% to our margin safety on this metric. Next we have the shareholder return, and here we'll be looking at the dividend growth and the share buybacks or dilution. As we can see, the dividends have been in an uptrend and a downtrend as well over the years. Of course, it doesn't look very linear, because also, just like the reporting, the dividends are also paid in British pounds and not in US dollars. But in general, it has been in somewhat of an uptrend. It has gone from $2.31 a share in 2014 to $2.85 a share in 2023, which is an average growth rate of 5%, meaning that it falls in the orange part of our scale, meaning no change in the margin of safety. In terms of share dilution, we can see that during their acquisition of Reynolds American, they have diluted shareholders by quite a bit, going from 1.8 billion shares to close to 2.3 billion shares. This is a dilution of 17.5% in 10 years, which is in the red part of a scale once again, meaning another 5% added to our margin of safety. And lastly, we have the capital allocation metrics, and here we'll be looking at the return on equity and the return on invested capital. The return on equity is calculated by taking the net profit divided by the equity, and this is a ratio that we would like to see higher than 12%. As we can see, BTI falls just short on this, with a return on equity of 11%, meaning no change in a margin of safety on this metric. And besides this, we have the return on invested capital, and this is calculated by taking the EBIT, the tax rate, divided by the invested capital. This gives us an idea of how effective the management is at allocating capital, and this is once again a ratio that we would like to see higher than 12%. And it once again falls just short of this, sitting at just 10%, so no change in the margin of safety on this metric either. Looking at all of this, British American Tobacco it's not looking so great so far, because we've only added to a margin of safety and we haven't seen any deductions. But let's see if the company can redeem itself in its valuation. So let's go look at the valuation models next. The first valuation model we'll be using is discounted cash flow model. Here we can see that the free cash flow has gone up over the years, going from $5.3 billion in 2015 to over $12 billion in 2023. This is an average growth rate of almost 16%. However, I don't think that this average free cash flow growth will be able to be sustained in the future. And we'll be lining out our discounted cash flow in three cases: a normal case, a best case, and a worst case scenario. In the normal case, we have a short-term growth rate in free cash flow of -5% and long-term of -3%. And we have a weighted average cost of capital of 10% and a perpetual growth rate of 3% that we'll be using in the other cases as well. The best case scenario is a 3% short-term growth rate and a long-term growth rate of 0. And in our worst case scenario, we have a short-term growth of -8% and long-term of -5%. When taking the results from all of these cases and weighing them accordingly, we get a sum of the cash flows of $117 billion. And then we get our equity value by adding the cash and equivalents and subtracting the debt, leaving us with an equity value of $77.6 billion. And dividing this by the amount of shares outstanding, we get an intrinsic value of $35 a share. And with the current price of $30 a share, this is an upside of 16%. The second model that we'll be looking at is the dividend discount model. As we can see, we have imported the dividend payments going from 2014 to 2023. Their average growth rate in the dividends has been sitting at 6%. I'm projecting their future dividend growth to be 4% on the short term and 2% on the long term, with a weighted average cost of capital of once again 10%. Then taking the sum of all of the future dividend payments, we get an intrinsic value of $51 a share, which is more than 69% higher than today's price. The third model that we'll be using is Graham's valuation formula. Here we'll be looking at the earnings per share that BTI is generating, the long-term growth rate projected by analysts, and the AAA corporate bond yield that is currently 4.5%. And we go by the theory of Benjamin Graham that the PE ratio of a company that is not growing at all should be 8.5. And looking at all of these metrics, we get an intrinsic value of this model of $41, which is a 37.5% upside of this model. The fourth model that we'll be using is the multiple valuation, where we'll be looking at similar companies to BTI and look at their stock price and earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 10.39. All that's left to do then is to multiply this average PE by the earnings per share that BTI is generating. which is $4.88 a share, giving us an intrinsic value of this model of $51, which is 70% higher than today's price. The last model that we'll be using is the mean reversion theory. Mean reversion theory, we go by the theory that a company will trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, we've imported the dividend yield of the past 5 years, and on average it has been sitting at 7.75, while the current dividend yield stands at almost 10%, making it undervalued based on this metric. Doing the same with the PE ratio, on average it has been sitting at 9.37%, while the current PE ratio is sitting at 6.11%, meaning that it's once again undervalued in this metric as well, giving us a mean deviation of 28%. And that results in an intrinsic value of $38, which is the same 28% upside as we got in the mean deviation. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Coming to our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $43. A margin of safety we've determined earlier, using a standard margin of safety of 30% and adding 5% for the debt to EBITDA, Altman Z-score, and share dilution, giving us a margin of safety of a whopping 45%. Applying this margin of safety, we get an intrinsic value of $30. And with the current price of $30, this is only a downside of around 1%, meaning that per our valuation, it is just slightly overvalued. But you have to keep in mind that this stock is not for everyone. Personally, all of the metrics that I've determined in the margin of safety are based on what I like to see in a company. And that might be different for an investor like you or an investor that is seeking income. So these are all based on what I like to see in a company, and that is why the company gets punished so severely. But if, for example, you would add a 20% margin of safety because that suits you better, you would get an upside of 20%. So it really depends on the person. For me, I know that this company is not something that I would invest in, but that might be different for you. So take your own conclusions in this valuation. Anyways, if you want to get access to these valuation models that I've used, as I've said earlier, you can head over to my Patreon that will be linked in the description. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.